How to build a long-term portfolio. Presentation mode. Can we get there? All right, here we go. All right, so who am I? I'm Joe Morgan. I'm a CFA, CFP. I take away my clients' money worries. That's what I do. Financial planning, investment management. I've been in this business for a million years, mostly on the institutional side, the last 6 years working with families. And it's very, very different working with families because a lot of emotions are involved. And we're going to talk about some of that today. What we're talking about, though, today is not financial advice. Financial advice is specific to you and your circumstances and your situation. So please don't take anything I say here as something that I'm saying you should do. I don't know what you should do. We need to be a little bit more consultative when we give advice. So these are simply money moves that I think are things that you could consider. You'll see there at the bottom of the page there, previous webinars. If you want to see any of those, shoot me a note and I'll send you a link to the recorded sessions. All right, financial planning is building our best financial life, not the best financial life on the block, but our own personal best financial life. And there's 4 areas that we look at: protecting what we have, knowing where it goes, that's the spending, making it grow, that's investments, that's where we're focused today, and retaining independence and dignity. That's the long-term forecasting, making sure we're making decisions today in the context of our entire lives. These 4 areas are equal, and we need to approach them with intention and purposeful effort in order to be successful over time. Again, we're looking to build our best financial life, and we get there, I think, primarily through clarity. If you have clarity on the options in front of you, the potential consequences, the likelihood that those things will happen, the rules and regulations, the tax laws, and all that stuff, you're going to make the best decisions for you. You don't need anybody to tell you what to do. You need someone to help you get to that point where you have that clarity. Here's my process, and I'm just showing this because I want you to see where investments falls into the process. It's way down here. We don't look at portfolios and structure portfolios until we know what our goals are, what our objectives are, what our spending is, what our cash savings target is. We get some projections of 5-year cash flows. Only then do we look at investments. We don't want to lead with investments because you can be right on investments and still lose in the long run. So what does long-term mean? For me, it's all the money that we plan to spend at least 5 years from now. So anything we're planning to spend within 5 years is not long-term money. That money should be set aside in a savings account or someplace safe because we know it's going out the door in the next 5 years and we don't want to risk it in the market. So if we know that we're going to need to do some repairs on our house, we don't want that to be dependent on what the stock market does. We've got the money, let's set it aside and let's get it done. So long-term is for those longer expenses, primarily retirement, but also things before retirement that come up. Now, why do we look at a long-term portfolio? Because we can't predict how investments will do in the short run. Nobody knows what the stock market's going to do tomorrow. Nobody knows what an individual stock is going to do tomorrow. Nobody knows what Bitcoin is going to do tomorrow. Nobody knows these things. So the only investments we can really predict are things like savings accounts, very, very short-term investments, very, very safe investments. That's what we're using for our under 5-year expenses. Now, why 5 years? Well, there's nothing really magical about it. It just sort of feels right. And we could do 4 years or 6 years, or we could change it if we want. But here's the stat that I think is important to understand. The stock market is up over 5-year periods about 88% of the time. So I would view that as saying, okay, if I've got the next 5 years taken care of and I'm only investing 5+ years, are you okay with a 12% chance that your investments will be down after 5 years? Remember, doesn't mean you've lost money. It doesn't mean you've cashed in and sold at a lower level. It doesn't mean you have to spend that money. I'm just saying that over a 5-year period, there's a chance that your stock portfolio will be down, but it's very, very small. Heck, there's a chance at 15 years. There's even a chance at 20 years, even though it's never happened. We don't really know what the future holds, so it is possible. But judging by the past, 5 years seems like a good number to sort of set on. Now, the bottom line here I think is important too. Markets have never stayed down. That's what we mean when we hear the market is at an all-time high. That means that if you had invested at any point in the past, whenever it was, no matter when it was, you're up through today. So even if you invested, and you felt you went through the crash, if you stayed invested, if you were able to stay invested, you've made money today. And we're going to talk a little bit more about that. I'm going to show you a specific example that I think will be interesting and hopefully eye-opening. So I want to talk to now a little bit about how most people invest. None of this should be a surprise to us. We do try to predict the future, even though we know nobody can. We do act on impulse or feelings, emotions. Some people, probably all of us at some point, will bet our savings on a tip or a hunch or something somebody whispered to us as if we have information that nobody else has. And we're all swayed by the media to some extent. And the media is not your friend here. Remember, the financial media, where do they get the revenue? They get it from their advertisers. Who are their advertisers? Wall Street. What does Wall Street try? How does Wall Street make money? They make money by you making transactions. They don't make money by you being successful. They make money by you moving money around. So the financial media knows that. So they hype things saying, you got to do this now. You have to do this. You have to do this. You have to do this. They're doing that from a profit perspective, their own personal profit perspective, because it helps their sponsors, and the sponsors are what pays the bills at the media. So I would just, I don't totally turn off the news and the media. Certainly, of course, I read all about what's going on in the markets, but don't get caught up in feeling like something that somebody else doesn't just because you heard about it on CNBC. That doesn't work. Okay, so let's talk about following our emotions. Now imagine this is the stock market going up and down and back up, because this is a correlation. When the stock market's going up like it is now, we feel a lot of optimism, maybe elation, right? So what does that mean? That means we feel good about stocks. So what do? We go out and buy stocks. We buy stocks. Let me say that again, another way. We buy stocks after they've gone up. That's what's happening there in the elation. Now look at the crash, comes down, we get nervous, then we get fearful. What do we do when we're fearful? We sell stocks, or at least we don't buy them. And when do we do that? After they've gone down. We're doing exactly the opposite of what we should do because we're reacting to our emotions. We want to try to avoid that or control that as much as possible. Very important. So how do we do that? Well, I think the main thing that we need is an investment philosophy. This is something that's true in all seasons and leads to an actual investment portfolio. So I'm going to walk you through mine really quick because we're already 9 minutes in and I got plenty more to show you. I believe in the wisdom of the crowd. Here's the wisdom of the crowd. Francis Galton in the UK, a statistician, 1906, goes to a fair, and there's a farmer there who has an ox, and he's having people guess the weight of the ox. He gets 800 guesses. Nobody guesses it exactly right. In fact, nobody really gets close. But look at the average, 1,197 pounds. The actual is 1,198 pounds. This happens over and over again. Here's another example, although a smaller scale. Jelly bean jars. Guess the number of jelly beans. Look at the range, 400 to 5,000. Huge range of guesses. Look at the average, right near correct. What does that mean? That means that if you take all of the people trying to guess what's going to happen individually, we're likely all to be wrong, or at least the overwhelming majority, so many that we can't guess who's going to even be right. So, but on average, we're likely to be closer to right. So what does this have to do with stocks? $440 billion in trades every single day. That's $440 billion showing up in the markets every day, guessing if stocks prices are going up or down, right? Now, we're not going to be able to outguess all of that money pushing prices around. We're not smarter, and we don't have the portfolio to push the market around. So we're just not going to play that game. That's part of our philosophy. Another part, well, this is really the summary, but another important part is that humans I believe, are designed to connect with each other. And we see this more, now in COVID than ever before. But really, if you think back to caveman days, I hunt, you fish, we'll share resources, right? The all the way up to the internet. What happened when the internet came online? Oh my God, we were all talking to each other. Not just talking to each other, but transacting with each other. And that's what companies do. Humans are designed to interact with each other. Companies are designed to enable those interactions and make a profit off of them. So when somebody buys a hot dog on the street in New York, there's a bun manufacturer that makes money. There's a hot dog manufacturer that makes money. There's certainly the vendor makes money. The trucking company that brought all the supplies makes money. The pig farmer makes money. All of these companies, all these entities make money. So if we can't predict which companies are going to do well, but we know as a whole they're going to do well, we want to own all of them. We want to own all public companies we can in the world, given the cost to do so. So that's our philosophy. Now, what does this require to be successful? A couple things. Um, Faith in the future. Things are going to get bad. We don't know when or why, but we have to have faith that they will get better, even though we won't know how they will get better. We have to have patience. We don't know when it's going to turn around. Remember that chart? Could be 3 years, 5 years, could be 15 years. We don't know when it's going to turn around. We know that it's going to turn around. There goes my dog again. And then my dog's a big fan of this. And then discipline. I don't care what's working right now. I care what's always worked. There's always fads. Fads go up and blow up. And what we need to have when we're talking about funding our long-term expenses for our family, something that serious, we need to have discipline and we need to do something that's always worked. And that's what we're talking about here. On the portfolio side, we need to have an asset allocation that allows us not to freak out. I'm going to talk a little bit more about that. We need to have diversification so that we're not, if any one company goes bankrupt, it doesn't really matter to us. Of course, if any one company goes up by 10,000%, that's not going to affect us a whole lot either. We're riding this wave of this investment philosophy of human interaction and companies enabling that interaction. And then we also have to rebalance and keep on target for our allocation so that when the crashes come, we get the experience we were expecting. Now, how do we lose here? Well, we lose by structuring a portfolio that we can't survive the crashes with. So this is the conservative strategy that I run. You can see the market crashes here, 2001, 2002, 2008, 2009. Here's COVID. If you had sold down here, look at what you missed. If you had sold during COVID, look at what you missed. The worst 35 days in the market ever during COVID. Immediately after that, the best 50 days ever during COVID. People who freaked out, who had a portfolio. I'm not saying freaking out was the problem. I'm saying structuring the portfolio before the crash, having a portfolio that you would freak out during a crash, that was the problem because we know crashes are going to come. So we don't ever want to structure a portfolio that way. Looking at the stock market returns, this is annually going back over the years. This most recent data is just through March 31st this year. Market's up 6%. It's up more now, but through March 31st, up 6%. Last year, we were up 16%. Previous year, 29%. That's what these bars mean. You can see the crash down 38. What I want you to focus on, though, is something entirely different. Focus on the red numbers. These red numbers are during the year, how much did the market drop? So let's look at last year. We were up 16%. But at one point during the year, we were down 34%. That was the COVID crash, right? Now just look at all these red numbers. They're not small, 6, 8, 10, 20. If you take an average, about 14%. So that means that even though people say the market crashes every 3 years, every 5 years, every 7 years, whatever they say, the reality is every year the market goes down some significant percentage. You're going to see that if you're watching your bank account, or I'm sorry, your statements, you're going to see your balance drop during the year. It's going to happen every year. We have to be prepared to understand that that is part of the deal. We're riding those waves to get, why? To get these returns over time, these high returns over time. And you can see all these negative things that happen. And even in the face of all of this, the market just continues to go up. Why? Because companies are designed to profit from those interactions and create those interactions, and they do a good job. Let's look at actual returns here for a moment. If you were born 1970, you're currently 51 years old. The S&P 500, the stock market, was at 44 on your birth date. Today it's at 41.59. If you had invested $10,000 today, you'd have $11 million. Wouldn't that have been a nice gift? The return during that period, about 10%. The return during the same period for other things, real estate, 4%, gold, 4%, inflation, 3.9%. Stocks are where it's at. Why? Because we've got humans who work for companies who are using their ingenuity every single day trying to make money for us. When COVID happened, what do you think the board of directors of any company did, of your company? Do you think they said, oh my God, I hope this ends soon. Everybody's got to go home. Let's just shut down and see what happens. No, of course not. Everybody turned on their brains, pointed their brains towards the problem, and tried to figure out how to make the company continue to make money. And some companies went out of business and some new companies came in, and there was no way to know which would be which. And so by owning all of these companies, we earn that average and we're gaining from that human ingenuity. Here's another example. Apologize for the formatting here. It looks awful. I agree. But here's the deal. We're talking about the last dumb buyer. Okay. So a little offensive, I know, but stick with me. What's a dumb buyer? Well, the market crash in 08 and 09, the peak of the market was October 9th, 2007, just before the crash. Market was at 1565. If you had bought on that day, now I think we could probably say, that person may feel like they're a dumb buyer of stocks, right? If they bought right before the crash, probably don't feel so good about it. Even today, they probably don't feel so good about it, except look what happened. With dividends reinvested, they earn 9.5% per year. They're up 245%. Who would like to be up 245%? Now, that person bought on exactly the wrong day, okay? And they still did well. And this works because this was their long-term portfolio. They didn't have to sell out in just a year or two. It was their long-term portfolio. So 9.5% was basically the worst annualized return you could get over that period by buying on exactly the wrong day. Now think about, alternatively, what about the person who sold at the bottom of the crash? March 5th, 2009, S&P's at 683. If they sold and stayed in cash, they missed out on an 18% return. So maybe buying on the worst day, maybe even that isn't so dumb. So I'm at time now. I'm going to do this. This is a summary. We're talking about the investment portfolio. 90% of your success will come from financial planning, not from the portfolio. What I'm going to do now is I'm going to shift gears and talk a little bit more specifics about the actual portfolios I work with clients on, and even my own personal portfolio. I'm going to share all that with you, as well as a link to do a risk tolerance test and have a conversation with me if you'd like to do that. Please put any questions you have so far or upcoming in the chat or Q&A, and I will get to those afterwards. But I'm going to continue on, and I appreciate your patience. If you have to go, take care, and thanks so much for attending. So here we go, self-managed solutions. I work with clients who manage their own investments, and I work with clients where I manage their investments. Two different portfolios. If my clients are managing their own investments, we use 3 different funds. That's it. Here's the very, very conservative allocation. Here's the very aggressive allocation. The top line is US stocks. The middle line is international stocks, meaning non-US. And the third line is bonds. And that's it. Very simple. We just want to structure, we want to pick the right mix that client is okay going through the next crash, right? That's what this is all about. Show you some stats. If we look at those 3 portfolios over time, this goes back to 1997. The aggressive was 8.3%, the moderate was 8%, and the conservative 7.6%. Not a huge difference, right? So the question is less which portfolio should I have from a return perspective, and more get the right amount of money invested that you can have invested over the long run. this is the compounding effect, right? You just want to be invested for as long as you can. And so you have to take care of your current liquidity. That's that 5-year cash flow, or the 5-year, not investing anything you're going to spend in the next 5 years. But so if you're taking care of your current liquidity, you can safely say, aha, my portfolio is long term. I'm going to let it go. So that's been the experience for the unmanaged, what I call the unmanaged portfolios. Those are the portfolios my clients manage. You'll see, going back a slide, all Vanguard, very low cost. For my personal portfolio, is an aggressive portfolio, and you can see I've got Vanguard bond funds, but I use DFA, Dimensional Fund Advisors, stock funds. And I'm not going to go into all the detail about that. I'm happy to discuss. You can Google them, Dimensional Fund Advisors. Very index-like, very low cost, similar to Vanguard, not as low cost as Vanguard, but the performance has been better. They do things that I believe work out better in the long run. Here's the allocation. So a lot more detailed when I'm managing it, because I can sort of take care of all of that. And then here's the relative performance. So here's the aggressive that I'm managing, and here's the self-managed aggressive. So a little bit higher return. That's it. That's what I've got. I'm going to put in the chat the links for the risk tolerance test. Let me do that right now. I have to concentrate while I spell. Click that link if you want to find out what your risk tolerance is. And then I'm going to put another link up here. If you want to have a one-on-one conversation on this topic, if you want to talk about your risk tolerance, if you want to talk about anything else, click that one and schedule time with me. Again, I offer one free session to anybody. Links aren't showing. Yeah, that's right, because I just posted them to myself. That's real good. Thanks for the tip. I appreciate it. Okay, once again, the link that has Riskalyze in it, that's the risk tolerance test. And then link. And then there's the one for the meetings. Thanks so much, Gloria, for letting me know that the links are going to the wrong place. Okay, so that's about it. Resources, I have a podcast that's out there called Deliberate Money Moves. And of course, my blog that we're starting to produce every week with a video. I'm pretty excited about that. Hopefully that'll be successful. The next webinar will be on July 8th, after the holiday, managing your cash flow. So here we're going to talk about how do we know what expenses we have in the next 5 years that we need to save for, right? How do we project our income? How do we project our expenses? How do we really look at that? So I'm going to show you in detail what I do there. There's my disclosure slide. Again, any questions, just pop them up in the chat or the Q&A. And I'm going to give it another minute or two, see if anybody's got any questions, or if this is just one of those Thursdays and we're all ready to go. All right, hedging against inflation with bullion, gold or silver? Well, I guess I would ask why you would want to hedge against inflation. Certainly gold and silver, all the precious metals, don't give hardly any return over time. So, they're not a good hedge over long periods of time. They can be a good hedge over very short periods of time, but you have to be right that the inflation is going to come when you say it's going to come. And then you have to have, if you're hedging your inflation, I assume you're hedging the expenses that you have. So we're really talking about what is going to happen to the prices of the things you actually buy. And is that inversely correlated with metals? Probably not, I would think. So I'm going to punt on that. I can't say gold or silver. I would do neither. The best hedge against inflation is to invest. Invest and grow your money north of the inflation rate, and stocks do that. Remember, companies have to earn more than inflation or they go out of business. So we've got built into our investment philosophy, into our portfolio, we own those 10,000 companies, we've got built in that hedge already. If a company's underperforming, they're going to disappear. We're not going to own them anymore. And somebody else is going to come in that can do better, and we're going to own them instead. So that's going to be our hedge. Let's see. What are your thoughts on crypto to beat inflation? I got to be honest with you. I have no idea about crypto. I mean, I know what it is. I was studying it 10 years ago. Was it 10 years ago? Maybe 8 years ago when I was at Silicon Valley Bank. We were banking a lot of companies and there was all this crypto craze, as you know, that when it started. And I was a chief investment officer, so I was asked to speak on it. And so what I spoke about was what it is, right? What is blockchain? How does it work? I'm guessing you guys know all that, or at least the person asking the question. Here's what I don't get for crypto. Um, the government can basically just, with a signature, totally wipe it out if they want to, right? I mean, it was illegal for a long time, and maybe it still is illegal. They're just not enforcing it. But it just seems like, it's not. There's nothing there. You don't own anything. You own a file, and I just don't know why you would put significant money there. Now, if you want to speculate, right, take a bet, write it up and sell it, hoping that that's the case. Make sure you do that with money that you're not planning, that you don't actually need in the future. Don't put your savings in that. But crypto to beat inflation, I don't think crypto is correlated with anything. So that's I if you believe it, even if you believe in crypto, I'm not sure that you can really say it's correlated with anything. I mean, certainly isn't historically in the data. So I guess those are my thoughts. I have clients that own crypto. I have clients that are big fans of crypto. That's great. I have no problem with that. But I don't like using the crypto as and projecting a return to, you know, satisfy what they're going to spend in retirement. I just don't think there's any way to do that. So fine, play with crypto, enjoy it, but don't make your financial future dependent on crypto. Some people got very lucky and made a lot of money, and good for them. But boy, I wouldn't do that. Any other questions? Not seeing anything else. What did you read to learn? Who did you talk with? Well, I got an undergrad in finance. I got a master's in finance. I got my CFA. I worked in finance my whole career. It's kind of my life. I'm not sure exactly. Maybe you can be more specific there with your question. But this is what I do. So who do I read now? Yeah, a lot of things I'm doing now, I'm drawing on my experience, frankly. Following the markets by reading headlines. I think headlines are really good. Reading stories can be really dangerous. I right now, I really enjoy the dimensional fund advisors, the stuff they put out. I like what Vanguard puts out. Those in, even the what do they call them? The boggleheads on Vanguard, the forums there are about 80% very good, 20% not so much. And so you kind of have to pick and choose with that. But yeah, I mean, this is what I do. So I don't there's not any one sort of guru that I follow. And I don't believe in gurus. I'm not a guru either. I'm just sharing, what I see. All right, folks, thank you so much for joining.